And today's topic of discussion is, we're not talking about spacecraft and lightning bolts and fire and flames. With options, your entire strategy is based.
Welcome back. I'm glad I didn't scare you away with part one of this video and you're eager to learn more about the FX market or Forex market. So in part two, we're going to go into a little bit more detail. We're going to touch on a little bit of the accounting side of things. We're going to talk about how you actually trade FX. Now you understand the fundamentals. If you watched part one, if you haven't watched part one, go watch it now. Thank you. Anyway, so now we're going to learn a little more details about how this all works. So just a quick review of the last video. We talked about the Forex market. So Forex market, basically you have a single market, unlike equities where you have all these tons of, New York Stock Exchange, NASDAQ, whatever. You have a single market. You can trade 24 hours a day, 5 days a week. So you can trade 3 a.m. in the morning, whatever. You have high liquidity, which it also allows you to do that. You can pretty much, the volume is always there. 5 trillion shares a day potential. You have a much lower cost than equities. You have a higher risk potential with an advantage of high leverage. So you have high leverage up to 101, but that also it's a blessing and also a curse potentially. You can make a lot of money using high leverage, but you can also lose a lot of money using high leverage. So you also have, again, we talked about 5 trillion versus, let's say, 4 billion shares a day with equities potentially compared to the 5+ trillion with FX. So those are the basics that we talked about in part one. Now let's look at trading FX. Let's look at that in detail. I'm gonna actually draw an illustration of what you might see on a trading platform. Like FXCM is a company that actually has a trading platform called Trading Station, and I'm gonna basically illustrate what you will see in that system, and this is something you're going to see in other similar systems as well, just to get you an idea, get a little bit more detail about how this all works, the actual nitty-gritty. You understand the fundamentals, but now let's get onto the surface. Let's get into some more details of trading FX or Forex. Let's talk about FX, maybe. Let's talk about you and me. Let's talk about all the good things and all the bad. I'm showing my age right now so much. Anyway, let's draw something that you might see in your GUI or your trading platform. So here in this box, let's put, the fundamental thing is you're going to need quotes, right? How are you going to trade without quotes? You need quotes, man. So you might see something like this. So you have this box here, and on one side, you might see like 95, and this side you might see 93. And then on top, you have the currency pair in question. So there you have euro, US dollars, and then you have price information. So let's complete this price information. So you might see here in small print, 1.35. On this side, you have 1.35 as well. And then you'll have your pip. Let's say it's 6. Let's say this is 3. And this will be moving up and down, depending on market movement. Some kind of indicator will let you know whether it's moving up or down, some kind of arrow, triangle, or whatever. And then you're also concerned with the spread. So the spread is basically the difference between the buy and the sell, because just like with equities, if you have any equities experience, then you are familiar with this. You can take a look at my videos as well. I go over in some of my other videos. I talk about order types and equities trading and stuff like that. But there's always going to be a spread. So the spread, again, is different between the bid and the ask. So this is on this side. This is going to be the bid. This is going to be the ask. Difference between the two is going to be your spread. And that is how the bank is going to make their profit. So if you're working with a company like FXCM, or there's also a company called, Trade King also has a Forex division. That's how they make their money, is the difference between the spread, which is between the bid and the ask. Additional information that you might see on this platform is it depends on whatever you're using, but you might see an indication of a low and a high, just like you would with equities. So you have a low and a high of the day. So maybe the high of the day is, say it went up to $2 or something, and the low of the day might be 1.1 or something. So you have an idea of the range. Now with the FXCM trading system, you also have access to charts. So you can have kind of a pop-up thing here that shows up on the side. and that's going to show you all the price movements and things like that. And then you're gonna see it's gonna have like actual little blocks like this that are gonna actually indicate the current quotes. All right, so you can actually kind of figure out what's going on. Like you can see this on the day, this price looks very low. So I got to decide, is it going to continue going lower? Is it going to stabilize? Is it going to go back up? It started high, maybe it's going to recover. You got to decide on that kind of stuff. And also you have the ability to enter like market orders and limit orders. With a market order, or limit order rather, you're going to be able to actually click and drag to set the price. So when you're going to buy something, you're going to buy based on a price that you enter if you're entering a limit order. Now you can actually click on that box and there's going to be a little line that's going to show up, and you can click and drag it, and as you drag it up and down the price scale, you're going to see the price change. So that's, instead of entering manually a limit price, you can enter it that way. And of course you'll see on this range, it'll be like, you know, say $2 here, $3. It wouldn't really go that high, but just to give an example. So you have some kind of a scale, say 0.8 or something, whatever. So that's the basics of what you're going to see in a trading system. Now, additionally, you might have interest rate information. You might have like buy interest rate, sell interest rate as well. This is fundamentally what you're going to see in your trading platform, your FX or Forex trading platform. Now, generally speaking, the way you think is, if I'm buying this currency pair right now, I'm trying to buy euros. So I have confidence in euros. I think the economy is doing great. I think the price is going to go up. You're going to be able to get more euros for your US dollars in the future. So I come in with, you know, right now the rate is 1.38. So I pay 1.35 US dollars right now for, let's put that here. So I pay $1.35 for 1 euro. That's how much I spent, because I think that the euro is going to go up. So let's talk about how an FX trade works and how you should think about FX trading. So obviously, like we said, it's all about currency pairs. So for example, hopefully you guys can see this. So we have, let's say, euro, our favorite major. In another video, I'll go over what the majors are. Majors being the most popular currency pairs out there, like euro, US dollar. So here we have euro, US dollars. Again, this is a counter currency, and this is your base currency. So the base currency is euro, and I like to think of it as a target currency in terms of this is what I'm targeting. That's what my focus is on. If I buy, then that's because I think this base currency, it's going to strengthen against the US dollars. So this is the way it's going to work. So you start off with US dollars, you pay a certain amount. So let's say you're quoted here $1.35. That means it's going to take you $1.35 to get 1 euro. So you start with US dollars, you spend this $1.35, it converts to a single euro, and then the idea is that the exchange rate moves in your favor. So let's say the exchange rate goes up to 1.8. So now 1.8 US dollars is equivalent to 1 euro. So remember, you spent $1.35 US dollars to get 1 euro. Now the amount of euros you have will never change. You only got 1 euro, it's always going to be that, but the value of the euro against the US dollar, that will change. So if the price goes up to 1.8, that means that when I exchange my euros back to US dollars, I'm now going to end up with 1.8 US dollars. Now, again, this is an oversimplified. We're not getting into all the details of the accounting. Commissions are very low, but there are commissions. The banks are going to be making money on the spread, basically the difference between the bid and the ask. There's other factors involved, but this is the basic concept of how it works. You're jumping from currency to currency. I go to US to euro. I think euro is going to go up. And when it goes up, then I can close my position by selling. And therefore, when I sell, I'm actually going to get more US dollars than when I started with. That's the plan anyway. But of course, it can go the opposite way. Let's say that the euros goes down against the dollar. So now it's 1.1. So now if I exchange now, I'm going to change my 1 euro into $1.1, which would suck because initially started with $1.3 and now we're down to 1.1. And you're probably wondering about accounting wise, like how do I sell a currency I don't have? And first of all, before we get into that, let's define a cross pair. So a cross pair would be like, let's get rid of this. A cross pair is a pair which is not in your local currency. For example, I'll give you an example here. Let's look at, by the way, these currency pairs actually have nicknames. So what we're going to look at right now is I'm going to look at what we call guppy. So a guppy would be, let's see, GBP against the yen, Japanese yen, so JPY. So you have an account that's funded with US dollars. Let's say you have $1 million, $1 million US. So how can you buy or sell a cross pair? So this cross pair features currency that you do not have. This is what you need to know. Basically, when you're trading FX, you're trading Forex, a lot of this stuff happens in the background. So you don't have to really concern yourself with that kind of stuff. All you're really doing is you're making decisions based on news, based on markets, technical analysis, whatever it is, and you're doing buy and sell. Now in the background, however, a lot of stuff is going on. So basically what's going to happen is essentially that kind of transaction, a US dollar funded account trading foreign currencies, essentially in the back end, they're going to be doing math. So look at it that way. In the back end, they're doing math. Don't think of it as a literal thing where there's one guy with yen and you're going to change US dollars to yen and then to, don't think about it that way. Just think about it as mathematical formulas. So if you've got US dollars in your account and you want to trade this currency pair, then they're going to do a double conversion. They're going to convert from the US currency amount to whatever the amount of yen is that you want to trade to go over to the pounds. So that's what basically happens. So there's one conversion from US dollars to yen, another conversion from yen to pounds, and then your account balance is going to reflect based on those calculations. So now hopefully if you're right and the pound value goes up, then when you convert back to yen, it's going to convert that value back to the US dollars, and the amount should be greater than what you started with because you're going to get more yen than what you started with. And then when you convert the yen back to US dollars, you end up basically profiting. So that's basically the way it works. So again, you don't have to worry about that stuff. That stuff happens in the background, so you don't have to really think about it. But essentially, again, they're going to convert from US dollars mathematically to yen, and then from yen to pounds, and then you're going to hold that position, which is called you're going long. Whenever you're buying, you're going long. Whenever you're selling, you're going short. So you can hold this position, and then you're going to wait for the price basically to move in your favor. You got to first get beyond the spread, of course, because again, there's a difference between the price of the buy and the sell. So once you've crossed the spread, and now you're starting to get to a point where you're actually able to sell for higher than you bought it for, then you go ahead and you close your position. You're going to sell this. Goes back to yen, and then the yen is converted back to US dollars. And again, you're not actually trading all these currencies. It's all mathematics. All you're concerned with is making your buy and sell decisions, setting your limits or whatever it is, your stop orders, and in the end, you're concerned with your account balance. If you trade effectively and you made the right decisions, then your account balance should be rising and rising and rising, and you are an awesome trader. But otherwise, all the conversions and mathematics and stuff like that, you don't really have to worry about because, again, that's all done in the background. That's all I want to cover in this particular video. This is really just a primer, part 2 of my primer, my FX primer, just getting you to understand what FX is all about, Forex is all about, so you can relax and stop being all scared of FX. It's too complicated. I don't know about currency pairs and all this math, and it's, no, just relax, breathe, count to 10. It's not really that complicated. Just take your time to watch these videos. Also, do your own research as well online. Lots of great information as well. You can go to FXCM's website. They have some great information there, or Investopedia. Those are great resources which can give you a little bit more detail. But I think I've given you a good head start, good foundation for you to get started on your understanding of how FX works. Thanks for watching. Don't forget to thumbs up the video if this was helpful for you. Don't forget to subscribe and share the video. Thanks for watching. This is Carlisle with Carlisle Speaks Wall Street.